Welcome everyone in today's session, Business Impact Analysis, the most important step during BCMS implementation. Thank you all for signing for this webinar. As always, I'm delighted to have you here with us. My name is Renata, the Portfolio Marketing Manager for Continuity Resilience and Service Management and the PCB organizer of this webinar. The presenter of the webinar is Renata Davidson. She works in the business continuity management area since 1998. She was the first professional in Central and Eastern Europe to be certified by Disaster Recovery Institute International. During the course of her career, she led tens of projects for blue-chip companies in Poland in all sectors of the economy. She is the founder and CEO of Davidson Consulting and Partners, a partnership of experts specializing in business continuity, operational risk management, and process management. At the end of the presentation, we have question and answer session. Therefore, please feel free to submit any question or comment you may have during this webinar in the chat box of your control panel. Renata will answer to all your questions accordingly at the end of the presentation. Thank you for your attention and enjoy this webinar. Dear Renata, you may start the presentation.
Thank you, Erika. Hello, everybody. It's not very comfortable situation for the presenter when we can't see the attendees, but I'm looking at the number and I'm thrilled that so many of you dedicated this half an hour or 45 minutes to listen to what I'm about to say about in this webinar. So the topic of today's webinar is my favorite one, which is business impact analysis. And unfortunately, I have no idea what is your experience in business continuity management and how many projects have you conducted so far yourself. So I tried to balance this presentation so it won't be very complicated, but also I don't want to annoy anybody with obvious data. So for today's webinar, we have three main points in the agenda. First, a very short review of the requirements of the International Standard 22301, because I guess that everybody has access to this standard. If not, then probably you have seen many presentations about ISO 22301, and you know the requirements for the BIA. The main point of this presentation, what I want to do during this presentation is first of all to share my experience and our method that me and my partners are using during projects, and to share also some mistakes which the list of mistakes that we gathered during the projects that we conducted so far, and of course to summarize the whole BIA topic and to point the significance of the analysis results. So thank you, Erika, for the introduction. Just short information about my company, because I want you to feel safe with us, with me, during this webinar. We have more than 150 business continuity management projects conducted so far in Poland, but also in Europe, because we also work for international companies, international clients in all industry sectors. So no matter what sector you are from, I believe I could answer your questions. We are using proven methodology since 18 years in each and every, it was proven in each and every project that we conducted, and our methodology is compliant with leading business continuity management standards. To conduct BCM project, you really need to know something about risk management and business process management. Therefore, we have also excuse me, experience about the related subjects. which are very helpful, particularly during BIA. So talking about business continuity management, I would like to point your attention now to the definition from the ISO 22301 of what business continuity management is. And basically what the standard is saying that the whole BCM is about main three things. First, we need to identify potential threats and the impacts of those threats that they might cause, and to provide the framework of an effective response. Business impact analysis is all about the impacts. So we are at the very beginning of the project. When we conduct business impact analysis, we are not interested in the potential threats, at least not in detailed causes of what might happen that our processes will be interrupted. We are focusing on the impacts of the business interruption. Another important requirement stated in the standard, in ISO standard, is to identify activities which will be subject for the analysis, which we will analyze. And the hint that the authors of the standard are giving is that you should focus on the activities which support the products and services of the company. So if you are not sure where to start, it's always a good idea to look at the list of products and services that you are, for instance, that your company has listed on the web page, or that when you are presenting what your company is doing, what is the main field of activity. Well, if customer is asking you what are your products and services, so this is a good starting point, and later to look at the list of processes which support this delivery of those products and services directly. And of course, the main goal of the business impact analysis is to assess the impact and what is important over time. So it's not enough to assess the impact, for instance, for one time frame like 24 hours or 2 hours or 4 hours. You need to have number of different time frames to assess it correctly. And later, after assessing the impact, then the goal of the BIA is to set the priorities and to identify dependencies of between the processes, and of course dependencies on the resources necessary to conduct those processes. So the good practice is to start the business impact analysis process by defining the context of an organization. And for the purpose of this presentation, this is my proposal. It's not obligatory. You can divide it in a different way, but this kind of approach works for me. So what you can see, we are dividing by defining the context of an organization. What we want to do, we want to identify requirements that external organizations, external companies, your customers, your environment, business environment might have towards your company regarding business continuity. So we usually divide it into 4 quarters. We identify legal requirements, contractual, financial or business objectives, and social requirements. And in the legal requirement quarter, we usually have the law, all the acts, the requirement of the regulators in your industry, public administration requirements, supervisory bodies requirements, which are, and what we are looking for the requirements which usually usually are connected to a specific terms, for instance, reporting obligations, that obligatory reporting, or some of the sectors, so-called critical infrastructure in Europe, they are simply not allowed by law to stop operations. They must be always available, and it's very often legal requirement. And the second quarter is all about the obligations or the requirement that might be connected to business continuity of your company, which are written into the contractual agreements, into contracts. So for instance, you in the contract you are obliged to provide service to your customers within given time frame or at the required level. So here we have all service level agreements, requirements, and key performance indicators which are in this agreement, which are defined in these agreements. Of course, you have also obligations towards your business partners, not only customers. So we have to look a little bit wider at this contractual requirements. The third quarter is business objectives of financial stability, and here we are talking about the shareholders, creditors, employees, which are very much interested in company resilience and viability, that you will be able to fulfill your financial obligations on time. And social requirements, here we are putting requirements from the environment regarding environmental protection. It doesn't apply to every business, to every sector, but it applies, for instance, to the power, the energy sector, or to the telecommunication also, because of radio waves, and of course the requirements from the community or citizens, if we are talking, especially if we are talking about public administration organizations like social insurance. Every citizen is interested in social insurance to work without interruption, especially when there are terms for payment of the rents, and also the neighbors or the whole sector. If we are talking, for instance, about national grid or this kind of companies, then the interruption in this particular company might affect the whole country. And here we have some sample requirements. I talked about most of them, so just briefly in legal requirements, the example is, for instance, the tax declaration submission dates, that they will be submitted on a particular day, and of course that they will be accurate. That's another requirement. Then in the second quarter, regarding contractual requirements, we have SLAs, KPIs, but also payment terms in agreements with our contractors and suppliers. And in financial stability, example is obligations towards shareholders. If we promise them that they will get a premium on the investment, let's say that they will get dividend of 10% within next year, then they are very much interested that the company won't lose money, won't get significant losses, for instance, from the business interruptions. And the same if we have credit lines or we have investment credit from the bank, then loan installments maturity dates are also critical, because we don't want the bank to back out from the credit, from the loan installment. And in social requirements, the examples that I gave is for the company which is, for instance, the major employer in the city or in the region that you are one big company, and the local community depends on your company. Like most of the citizens are employed by you, for instance. Of course, citizens' well-being, if our company can cause harm as a result of an incident or business interruption, and of course, protection of an environment. Then when we have all those requirements defined, usually we prepare a list where each and every business unit is filling the requirements in these 4 categories. Sometimes many units is putting on the list the same requirement. It's fine. Later we are merging it, verifying, and of course we are not able within short time to identify each and every requirement that might have something in common with business continuity, but at least the most important ones are easily identified. And the next step, looking at those requirements and looking at the list of company business processes, we can pretty accurate define the business impact analysis scope. What we are looking for operational processes which are in the end are which are directly supporting product, service, or they are directly supporting fulfilling legal requirement. So it's either delivery of the product, delivery of service, or making some data available, depending on the sector. What is important is that we are looking at the processes that have direct contact with the external world. And the same regarding legal requirements. There might be reports. Usually when we are talking about legal requirements, then it's some kind of reporting most of the time. And settlements are another example of the area that we have to look to define the scope of the analysis. What we are not taking into consideration at this stage, we are not analyzing IT processes, IT operations. We are not analyzing administration or audit. In one sentence, we can say that we are not, in business impact analysis, we are interested in impact on the business, not on the supporting functions. All these supporting functions are providers, internal providers of critical resources and critical internal services, but they are not producing anything, they are not servicing our customers, and usually they are not directly fulfilling legal requirements. Why don't we do it? Just a short example. For instance, if we will analyze what impact it would be on the company if our IT operations are interrupted, then we have single process and all the possible losses that company can endure as a result of this of the IT processes interruption. All the losses are in this one process. So we cannot set priorities. We don't have good visibility, what is more important, what is more critical, what can wait maybe one day. That's why we are looking at business, and in the next step we will identify resources, and then we will have the list of IT services, IT systems which will be the subject of risk analysis. But this is this is the second stage of the project. So today we will focus only on analyzing the impact on the business. Therefore, we are looking at the operational processes, the ones that provide products and services to the external world, and settlements or legal requirements, which usually means reporting. And now when we have the list of the processes defined, when we have the scope of BIA defined, with each process which is in the scope of BIA has assigned a business process owner. If there are some doubts who should be the business process owner of the particular process, it's always the question, it's good to ask yourself a question, the question who is setting, who is deciding how this process should be run. So it's this business unit which has the most important, which makes the most important decisions regarding how this process should be designed, how it should be run. If it's not enough, then another useful hint is, if we interrupt this process, who will be in most trouble? Who will have to go to the board of directors, to the management board, and explain himself what happened? Or maybe it's not the best idea. Maybe think about who will have to justify himself or explain himself to the external world. That is usually a very good indicator of who might be the business process owner. So talking about impact assessment and the potential consequences, what is the recommended approach? First of all, it's good to work per process by process. So we have a list of processes, and each of the processes is being analyzed separately. It's very important that all the processes are being analyzed in the same way. So it's good to start with people. It's counterintuitive. People are not thinking about the worst case scenarios. So it's always good to start with business process owners setting the worst case scenario, defining the worst case scenario per each process, because they might be critical in different time frames. They might affect different group of customers. So it's good to focus on each process separately. And if we have process of delivering a wide range of products, then it's good also to analyze the potential impact depending on different groups of products. In factory, for instance, we can talk about production lines, because then we can also set priorities per group of products, or even per product. If the more detailed the analysis, the better decisions in the end. So we start from the worst case scenario, and to set the worst case scenario, first we have to answer the question, what would be the worst possible time for the interruption of my process? And by the worst possible time, first we are asking the questions, which season of the year, which quarter, or maybe which month, and in, let's say, December, and in this month, which week. And for instance, in retail sector, it's usually the second week of December, because this is when all the people are going to purchase gifts for Christmas, or food, or some services. So the worst possible week, let's say it's the second week of December. What is the worst possible day? And in retail, again, let's keep this example. It's usually Friday or Saturday, when people have more time for shopping. And what time on this particular day would be the worst possible time for interruption? And when we set this detailed time frame, this is where we it's good to note it. I mean, we actually make it obligatory that this worst case scenario has to be defined. It has to be defined in a written form. If our product or service is being delivered to a different group of customers, for instance, the key customers and the individual customers, which are many, but if they might have huge impact on reputation of the company, because they will be complaining on social media and on the internet, on company webpage. But looking at the turnover, we might want to, the worst case for our company might be that the interruption affects our key customers. So we have to, if it's relevant to the process, it's good always to keep it in mind, and even to write the name of the customer that is affected, or the name of the group of the customers. And another important point is that you have to assume that none of the control works. None of the backup solutions works. Business impact analysis is analyzing so-called inherited risk, which means the risk that doesn't take into consideration any backup solutions, because we want to see, in the worst case, if nothing will work, because it happens sometimes that even despite the effort we put into implementing protective measures, none of them works. We want to see what will be the maximum potential loss. That's why we don't take any optimistic assumption. We are very pessimistic here. So we assume that none of the control works, because we want to see what is the inherited risk, what is the highest impact that we have to prepare for. And this is very counterintuitive, and people are usually thinking, or they are usually commenting during this stage that, but it's impossible that it will be interrupted. I'm sitting here working 24 hours by 7, that this process will be up and running. We are a responsible company, etc. We all know, we know all those arguments, and usually there are so many protective measures, so many solutions, because this process is critical, and we want to only want to measure how much critical it is. So that's why we are not taking any controls into consideration. And the last point, the worst case scenario, is that the interruption is your company fault. So you cannot apply the force majeure clause, that it was act of God, that it was external bad weather or whatever. Let's assume that the worst case is that it's either your neglect, or it's a human error, your employees made a mistake, somebody forgot something. It could be sabotage, but generally it's on your side. The fault is on your company side. So this is the worst possible scenario for the process. The next step is to, when we have this, the worst scenario ready, this is when we can start calculating the impact. And it's important that we have to calculate impact in financial and non-financial terms. Financial, it's, of course, it's money, so we have to calculate it. If you are a multinational company, it's necessary to agree on which currency which currency are we using, whether it's euro or US dollars, depends. I also worked with the company that was and that was using their own local currency, not euro or US dollars, because that's how the group is making settlements between the companies within the capital group. So it's always it's usually a very simple decision, but it's important that we calculate everything in the same currency, so we can easily compare later the financial impact among the processes. For non-financial losses, it's good to set the scale. We use scale from 1 to 5, and there are different arguments for whether the number should be even or not. Because when you have scale from 1 to 5 and you're asking people from 1, nobody noticed anything, and 5, it's a public relation disaster. Everybody is talking about us. We are on the, and talking about us in a negative way. What is this 3 in the middle of the scale? There is always this problem, what is this 3? So, but whether you want to use the scale of 1 to 4 or 1 to 5 doesn't matter. It's just that it has to be the same scale for all the processes. And the steps on the scale have to be defined very precisely. What does it mean, 1? What does it mean, 2, 3, 4, and 5? They need to be defined in so-called discrete way, that people who will be answering the questions or filling the BIA forms have no problem with with assigning the correct level of non-financial loss. And of course, the losses must be estimated in several time frames. We usually use these time frames from 1 hour, 4 hours, 24, 48, 72 hours, which is 3 days and 5 days. In general, because it depends on the sector. If we are working with the customer who is in a very time-sensitive business, like for instance telecommunication or IT services, then this 1 hour, sometimes even minutes, are important. Even this 1 hour is too short. But for most of the businesses, we start with 4 hours, which is half of the business day, 24 hours, which means 1 full business day, and we end with 5 days in most of the cases. But if the company is working in a continuous mode, 7 days a week, then then we end with 7 days. We want to see 1 full week, because there are processes which won't bring any negative impact for or maybe which won't bring any significant negative impact on the company, but within the first 2 days or even 3, but in the 4th or 5th day it may be disaster. The customer might cancel the agreement or cancel the order, or it might be some serious legal repercussion. So depending on the sector, these time frames should and usually are adjusted, but the most important thing that they should be exactly the same for all the processes that are being analyzed. And when we calculate the loss, whether it's financial or non-financial, we calculate it in an incremental way. So we are looking how much we can lose if we interrupt this process for 1 hour. Then we are not doing anything. The process is in a complete stop, is interrupted. How much do we lose after 4 hours, 24 hours? We are checking whether these losses are growing, whether they are increasing. And the losses need to be calculated on an actual financial data, and usually we are looking at the last 12 months, because like every impact analysis or every risk analysis, we are interested in what is the impact today. We don't want to look at the historic data. We want to know, we know that maybe 2 or 3 years ago the company had much bigger turnover and the biggest transactions and the biggest customers were cooperating with this company, but today the business may be much bigger or much smaller. We want to see what the impact would be today. what is of most importance is, is that we are using peak values. So we are looking for the highest number of transactions, the highest values of those transactions. If we are analyzing, for instance, the tax payment process, then we are looking at the highest amount of tax that was supposed to be paid but wasn't paid on time or wasn't reported on time, and what is the penalty from these highest numbers. Talking about penalties, if regarding legal requirements, very often we are not the losses are caused by the penalties which are written in the law, and sometimes they are written in such a way that we have two limits. That there are some limits. For instance, that this legal requirement, if you won't fulfill it, if your company won't fulfill it, then there might be a penalty between $5,000 and $50,000, euro, or whatever. Then we are always looking at the highest maximum value of the penalty, because we have no guarantee that the regulator or the office that is authorized to assign this penalty to our company, that they will use the minimum value. We are looking at the maximum values because, again, we want to calculate the maximum potential loss for this particular process interruption. And I mentioned already that when we are talking about non-financial impact scale, we are talking about discrete values. I mean, the values must be very well defined. So, for instance, we should avoid using vague statements like, for instance, serious impact or big impact. Big, it means what is the impact on our image, or what is the legal impact. Does somebody face imprisonment? Is it in national media or international media, or maybe it's just an article in the local newspaper, but maybe local newspaper in our business is the most important one. This non-financial impact scale is usually defined with the business process owners very often during business impact analysis workshop at the very last moment, so everybody is absolutely clear what particular steps in the scale mean. Okay, the distribution of losses is, this is just a very simple example of how the distribution of losses may look like. What I wanted to present, to point by showing you this, this picture is that very rarely losses are growing in line, are linear. Very rarely. Usually there are, if the process is recurring, then there are some, this is when the losses are resembling a simple line. This is the closest to the linear loss that it can get. But regarding processes which have contractual requirements, there are very often clauses in the agreements which are saying that if you won't deliver product or service in a timely manner, then there are penalties which your customer can I don't know, there are penalties which you will have to pay to the customer, but very often in the agreement there is a limit, that these penalties cannot be more than the value of the contract, more than some particular amount, or the percentage of the contract, so very often they are limited, and then if we reach this, this level of loss, then the losses, at least financial losses, don't grow anymore. And regarding legal requirements, very often there is a very fixed term that if you want send this, if you want report something, if you want fulfill this particular legal requirement on a given day, sometimes even given time, then you might be fined. You might be fined by the regulator, by the authorities, and this fine doesn't change in time. So it's if you didn't fulfill the legal requirements, then the risk of fine is already there, and we have to take the maximum value of this fine into our calculations, and it doesn't grow. So when we have collected all the data regarding financial and non-financial losses, then there is the next step of the business impact analysis is to define business continuity management requirements. And how do we do it? Then first we need to set recovery time objective, or differently we could say we have to decide what is the maximum time that we can for which this process might stay interrupted. And to answer this question, we need to set what is our maximum acceptable loss. And we might say that in this company we don't want to lose more than for thousands, for millions, for billions, depending how big the company is. Or for instance, we don't want to exceed 4 on a 5-level scale of non-financial impact. So anything above level 4, it's unacceptable. And we can clearly see that to avoid the losses which are equal or are exceeding a level of 4 millions or whatever the unit is, we have to recover our processes earlier than 24 hours. Because after 24 hours, these two processes are exceeding, this process is exceeding our limit, our loss limit. And of course, it's not RTO for all the processes. I wanted to simplify this this drawing, but we can imagine that if we are talking, for instance, about this process here, which is regulatory requirement, and we have regulatory fine here, so we might move this RTO before 4 hours even, which means that we want to be able, the worst case scenario for this process will be that we are not able to submit the report on the required date, so we have only this remaining number of hours to do it. Therefore, our RTO should be shorter than 4 hours, maybe 1 hour, maybe 2, maybe 3, but it should be shorter than 4 hours. When we are talking about this process, which is contractual recurring process, we can say that, well, we can easily accept longer recovery time objective. For instance, we can move it to 48 hours or less. Oh, sorry, no, it's here, yeah, so it will be like 25, 26 hours, maybe 30, yeah, before it will reach then an unacceptable level here. And it really depends on the process and how the losses are growing in process by process. But here, for the purpose of this example, we have RTO set on, let's say, 22 hours, and all which is above 24 hours is unacceptable to us. So the remaining business continuity management requirements, based on our worst case scenario and based on our loss calculation, financial and non-financial, is what is after we recover our process, which we said that RTO is 24 hours, what is the minimum level of process resumption? And the good idea is to give description exactly what should be recovered first and at what level, or percentage. For instance, we want to, after 24 hours, we want 50% of our customers to be able to use our services. We want to provide services to 50% of our customers. Or that first of all, we are recovering our delivery of our product or our services to this group of customers, and then the remaining customers will be recovered within the next 48 hours. So we can either describe the minimum level, we can give percentage, or we can set priorities. And the last question that we have to answer is, based on the worst case scenario, based on the recovery time frames and the minimum level of process resumption, what is the maximum time that the company can work on this minimum level defined? And sometimes it's sometimes it's a very short time equal to RTO, which means that we have to recover 100% of our process. Sometimes these times are very long. For instance, the next reporting deadline, like 30 days from now, or sometimes the next quarter. But very often this maximum time after which business process has to go back to normal is like 5 days, 2 days, 3 days, usually there are days. And in very time-sensitive sectors like IT, telecommunication, or even energy sector, we are talking about minutes, or sometimes there is zero. The process cannot be interrupted, and we have to prepare for. We have to protect it. We have to implement such solutions that will minimize possibility of interruption of this process. What is important is this time. Excuse me, just one moment. Okay, because I just want to make sure that I was understood correctly. This type usually it's longer than RTO, but sometimes there are such cases where these two times are exactly the same, and then it means that the business process has to be recovered fully within RTO. Sometimes there are technological processes that you cannot minimize, where you can't minimize the level of process resumption. It's binary. It either works or it doesn't work. And sometimes it's because the process is so critical, and for instance the legal requirements do not allow us to reduce the level of process resumption, that we are legally obliged to recover it fully. And how such BIA results summary looks like. Of course, this is simplified version, but this is really how we present the results of business impact analysis. So first we set the business, we define business process owner, then the process name, then the worst case scenario for this process. It's not easy to put plenty of information on a PowerPoint slide. So here these worst case scenarios are very simplistic, but I believe you get an idea. And the financial losses, which in the real world will be, here we will have several columns with for each and every time frame that was analyzed, so it will be like 5 or 6 columns, and we will see how these numbers are growing, the numbers of financial losses. The same with the scale of non-financial impact. It will be exactly the same columns, and we will see how the non-financial impact or the reputational impact is growing on the scale from 1 to 5. And here we have these BCM requirements: RTO, minimum level of resumption, and maximum time for back to normal. And you can see we have 3 processes: production of energy and heat, salary payments, and obligatory reporting. We have the worst case scenario, and financial losses. And as you can see, there are sometimes processes, for instance salary payment, which really don't cause much financial loss. There are interest charges from the salaries, that's all, at least here in Poland. This is the only loss that that company will consider. But on the non-financial impact scale, it's 4. On the 5-level scale, it's pretty high, because it's a big problem for internal public relations. We don't. We want our employees to feel safe, to feel secure with our companies. So the RTO is set for 24 hours. The minimum level of resumption is if we are not able to pay the salaries according to the actual data, then at least we can repeat transfers, money transfers from the last month. And we want to have actual data to calculate salaries within the next 5 days. Just an idea. And here we have energy and heat production, which is critical also because of the financial loss and because of the non-financial impact. And the RTO is 0, which means we don't want this process to be interrupted. But what it means, what is the minimum level, if we have blackout, what is the minimum level of resumption of this process? And you can see that here we are not talking about producing energy, we are talking about protecting infrastructure, including the distribution network, especially during winter. It's important that we protect the heat distribution network, so we are able to recover at all in the, within the next 8 hours. As you can see, the maximum time for back to normal is 8 hours. But the RTO 0, it means that even if disaster happens, at the minimum, we want to be able to protect the production infrastructure and the distribution network. Okay, yeah, and finance, this one is maybe it's a little bit, the penalty is higher, double the interest charges that we might pay to the employees. So let's say it's a significant amount for this exemplary company, but the non-financial impact is very low. Nobody will see if your company won't meet the reporting deadlines. Of course, nobody will see except the regulatory body that you are reporting to. So, but we want to avoid this penalty. So the RTO is 4 hours, which usually means that within the same business day we want to submit the report, and we want to submit it based on available data and to correct it within the next 2 days. That's why the back to normal is 48 hours. So these are very important questions to be answered, and that's why in BIA, to participate in a BIA workshop, we invite business process owners, directors of the business units, people who are the decision makers. And now what are the, how to avoid the most common mistakes in business impact analysis? And first of all, that you have to be very careful when you are setting the scope of the analysis. It's very easy to make it too wide or too narrow, and it is a good practice, and it is also a requirement in the ISO to justify any exclusions. Why don't you analyze particular group of processes? For instance, because they are supportive, because they don't deliver directly any products or services. You just need to define it. Too wide, you can still get very good results, but the problem is that it's very time consuming. Yet the organization is tired, doesn't respond very well later to business continuity management project or to business continuity manager himself, because they're afraid of too much work to be put into this analysis, and where most of the work won't be used on the later stages. Lack of objectivity, so-called expert methods, descriptive methods, where you cannot easily compare the results between processes. The more objective data, the better. Using average values, where we can see that, where we can say that on average we have such and such amount of orders from our customers. If we are avoiding peak values, then we cannot really go to the management board and tell them that this is the maximum potential value, because we were not working on maximum values. Another mistake is assessing residual risk instead of inherent risk, which means that we are assessing the potential impact taking into consideration existing backup solutions. Again, we are making optimistic assumptions which might skew the results and might not give the maximum potential loss to the management board. Another mistake is that people sometimes, especially sales departments, are including opportunity costs into financial losses. So, for instance, if we are not working for one day, then usually there are 5 inquiries or requests for proposals, and if we are not working, we might miss this 5 requests of proposals, because that's the maximum amount of requests of proposals that we received during one day within the last 12 months. The problem is that the request of proposal is not it doesn't actually mean that that you will win this offer, that you will sign the contract. So if we are calculating it, first of all, there are assumptions based on some expert experience, but and the second is that you are calculating opportunity cost, not real financial losses. So you have to be very careful here with this point. Vague descriptions in the non-financial scale, we already talked about it, the significant number, media interest, etc. We want to define it. What does it mean? The significant number, it means how many or how much. Inconsistencies between the loss level and the worst case scenario. For instance, we are writing in the worst case scenario that there is X percent of the contract, that there is a penalty in the contract defined as percentage of the contract value per day of interruption in delivering the product or service, but the financial calculation does not comply with the scenario. So it requires, we have to focus that this data, financial data or non-financial impact makes sense with the definition of the worst case scenario. Inconsistencies between the loss level and the BCM requirements. For instance, we have very low financial loss, almost no impact on reputation, non-financial impact is 1 or 2, and the RTO, recovery time objective, suddenly is 1 hour. And the question is why? Is it because your requirements, because the business process owner requirements are too high, or maybe the person that was filling the form or that was answering the questions didn't mention something, that this person knows that there is some impact hidden somewhere, but they didn't put it in the worst case scenario, and because of that they didn't calculate this risk. So if there are such situations that the loss level is very low and the BCM requirement is very high, then we always have to ask for justification. And the last important mistake that I want to point your attention to is the unnecessarily repeating the same loss in multiple processes. So, for instance, especially in heavily regulated markets like energy sector, there is a penalty, at least in my country, in Poland, this is how it is, that there is a regulator's penalty which is very high, and a regulator can give it for almost for many in many situations. And then if we will sum it up, if we will put it in several places, so to summarize the BIA, we will come out with some astronomical value which is completely improbable and unrealistic. So if we are calculating it usually in one place, assign it to the one process, and later if the same loss, if interruption of different process may result in the same loss, then we are only referring that it's as in such and such process above, yeah, that the result will be this penalty. It's the most common situation is when we are talking about regulatory penalties, and we have to be careful not to multiply it unnecessarily. And the last slide, it's what is the significance of business impact analysis? First of all, is the most important step in the project, because if you will do it wrongly, then the scope of the whole business continuity management system will be wrong. That it will either omit something important, or it will be too wide, it will be then too expensive, too difficult to manage, and we want to make our system efficient and workable. And a business impact analysis defines the level of acceptable risk, so-called risk appetite. So there are no discussions later on, why is it 2 hours, why is it 2 days, because the BIA is, which I should have mentioned before, the BIA results should be accepted by the management board. So after such formal acceptance, and after such formal acceptance by the management board, we have pretty low risk of any problems later on in the project, that people won't be confronting the list of critical processes and the business continuity management requirements. And what is important, the management board can change everything. They can change RTO, they can change the minimum level of resumption, they can change the maximum tolerable, maximum time of going back to normal, and they can change the list of critical processes themselves, because they are the people who are responsible for the company. So it's up to them to define what is the level of the risk appetite. BIA also defines, of course, business continuity management requirements. So if your customer will ask you what level of protection do you offer them if you have this business continuity management requirements, you know what to tell them. You know what is the maximum period of disruption. You can tell them what your RTO is. You can say what is the minimum level of the product or service that they can count on. Of course, it also defines the causes of losses, potential losses, because of the definition of the worst case scenario, and it's very useful data for risk assessment and business continuity management strategy, where in risk assessment we are looking for events, for threats, which might cause interruption and which might cause the losses that we identified in BIA. And in business continuity management strategy, we are deciding how do we respond to those threats, how do we fill gaps between what we have now and what we need in order to achieve the business continuity management requirements. That's the last point for today. I can see that I took much longer than it was earlier when it was planned, so I'm very sorry about that. And if you have any questions, of course, I'm willing to answer. Thank you.
Thank you, Renata, for this informative presentation. We have received a lot of questions, but because of the time limitation, we will only take the first one, and the remaining question will be answered through email by the presenter, in this case you. So the first question was, what is the maximum interruption time period the BC planning should plan for?
Once again, what is the maximum interruption period?
Yes, that BC planning should plan for. Business continuity planning.
Yes. Usually when you plan, you focus on the minimum time on the minimal values. Maximum interruption time, that means for what is the longest period of interruption that you prepare business continuity plan for. Okay. There is such term like the time for which the plan should be prepared for. So how long is the emergency situation? How long emergency situation will last? And usually we plan for 5 days. It's not that it should be like that, but because most of the critical, truly critical business processes are critical within the first 24 to 48 hours maximum. So we come from the assumption that if we are able to recover all our most mission critical processes within the first 48 hours, we still have 3 days to think about what about the rest of the processes, what are our priorities for the less critical processes. So we are preparing plan for 5 days, in most of the cases. But sometimes there are so well prepared companies that they're able to plan in detail even up to 21 or 28 days. That's, I think, the maximum period that the plan was prepared for. But 5 days, it's something that will allow us to recover what is the most critical and think about what do we do next and do some preparations for the next processes. If I understood your question correctly, this is what we have in mind when we are writing procedures and planning emergency resources.
Thank you for this answer. And I want to thank you again for this excellent presentation, and I want to thank all the attendees as well who have joined us today. We hope you enjoyed this webinar. Please be informed that this webinar is recorded and we will upload it in our official YouTube channel and in our website pcb.com. Once again, thank you all and enjoy your day.
Thank you. Bye-bye.